Okay, Arnaut. Looking forward to meeting you, buddy, my trading warrior brother. I'm making you the presenter, so we should be able to see your screen, hear your voice, all on a drop-down menu. Oh, that's a nice scene.
Good morning, Dale. Can you hear me?
Yes, Arnaut. Comment allez-vous?
Très bien, merci.
Oh, je suis fromage.
Oh, it's just...
All right, that's as far as, see, that's my second language. French is my second language. Anyway, great to meet you. Thank you so much for coming in.
Likewise, thank you for having me so much on your show. I'm really honored, and let's see what we can talk about today.
Yeah, and everyone who's here, Arnaut really likes interaction during his interviews and any kind of webinar he does, so feel free to fire your questions as we go through some of the looks and views that he gives us. But where I'd like to start, beautiful family, Arnaut,
thank you.
How did you get started? You know, what were you doing before you became you know, a trader, an analyst, whatever your business model is? Looks like you have a subscription service. Who do you blame for getting you into the industry?
I can only blame myself.
All right, well, that's good.
Well, like everybody else, I got, of course, interested in the stock market when we got the 2008, 2009 you know, big crash. I'd actually already been investing when I started high school, believe it or not. I somehow convinced my parents to not put some of my allowance in a bank account, but to buy some, you know, I would say mutual funds, like you know, like a SPY or something like that. It was more like a Vanguard type of bank account, and that went quite well because that was early 90s, and you know, by the time I was done with high school, which was around 2000, so there was a big top in the market. I actually took my money out because I needed to go to college. Believe it or not, my timing was good. All the time, of course, in college, I wasn't really interested in the markets. You know, it's more about drinking beer and chasing tails than anything else. Yeah, and then
best days of our life.
I know. And
where did you go to school? I noticed you live here in California.
Yeah, so I'm originally Dutch.
Okay.
I went to school in Holland, of course.
All right.
I got a bachelor's degree in environmental sciences. I then moved to Sweden to do my PhD and master's, also in environmental sciences. And there I got married to a Swedish gal and moved to the United States about 15 years ago because she was actually a U.S. citizen by birth.
Right.
And I was like, well, you know, I'm highly educated doctor in environmental sciences. California, you know, it's very environmental oriented. Shouldn't be difficult to get a job. Yeah, very green. And you know, believe it or not, I had to start off at IKEA because most companies just have a difficult time evaluating the worth, so to say, of a foreign degree. And at some point was like, well, I got to start low. So here I am, you know, doctor in environmental sciences, started off at IKEA. 2 months later, I was floor manager at Home Depot. 2 months later, I worked for a private consulting company, and then moved to a private nonprofit research organization where I worked for 10 years on the environmental impacts of generating electricity in the United States. And well, at that time, of course, the 09, 08 crash happened. I got interested, and I, started going into the markets. I got in contact with a guy who studied Elliott Wave, and I thought it was really interesting. His name is Pretzel. He is relatively known, I would say, in the retail investment kind of area of the market. And he taught me a lot about Elliott wave and how the markets move and Fibonacci and all those things.
So
Unfortunately,
you had a mentor.
I had a mentor. Our views started to differ. That he thought it was a bear market after '09, and I thought it was a bull market. So we kind of departed on equal terms because he's quite bearish and I was bullish. I then met Tony Calderon online, who uses objective Elliott wave, which is more of a true price-based method for doing Elliott wave than sometimes a little bit more of a hand waving and guessing type of Elliott wave theory.
Okay.
And he was my true mentor. He provides courses that I took, and he really took my analysis of the markets to the next level.
What's his Twitter handle, Arno? You know?
No, not off the top of my head, but
okay. Well, invite. You know, do you talk to him still?
Oh yes, we're on very good terms. Yes.
Well, tell him. Feel free to extend an invite to him. I'd love to talk to mentors too.
Oh, so, sure, I will certainly do that.
So, it looked like you know, you were fortunate, blessed to have landed with Anthony Calderon instead of a lot of the junk that's on the internet filled with barracudas, sharks, and charlatans.
Right.
So, you know, congratulations, your guardian angel is looking out for you. So, why don't we get right to it and delve into what you're seeing here. It's a great time to have Elliottician, and you know, I'm interested in a cycle I never heard about. Benner is the Benner. He's an analyst. I think he's an Israeli. Is that correct? There's a guy named Benner.
Oh no, this man passed away a long time ago. He published his work in 1875.
All right.
No, I forgot to bring my book where I have some of the background on him. As far as I know, he was a blue-collar man, if not a blacksmith. Please, you know, correct me if I'm wrong. Who found out that there are certain business cycles that the economy has to adhere to. He found several cycles that you can see here. I'm showing. So this work was published in 1875. You know, that's when he wrote his work. I think it's really started being applied in 1902. So this has been around for a long time. And back then, so using 8, 9, and 10 years as business cycles, as well as 16, 18, and 20 as business cycles, he could start to predict when economies would top and would bottom. So here,
so do you agree? Do you agree with his work right now? The box saying 2018, we're at major highs, or can we just get a nice, you know, maybe 10 to 20% correction and blow off again? What do you think?
Yes, that is definitely possible. Of course, cycles can also be a little inaccurate.
They can invert. They can invert too, can't they?
They can invert, yeah, for sure they can. I am not a cycle specialist, but you know, they can also be plus or minus 2 years, right? If this is something that has been forecasted in 1900, give the person a break that we're maybe off by 1 or 2 years. But so let's go over what he predicted in 1875, and look what he got right. So he got 1929 pretty good as a market high. I mean, that's the most famous market high we can ever imagine.
Right.
Then he said we would have a major low in 1933, which became 1932. Well, you know, off by a year.
Good enough.
Good enough. He has the 1967 low, which was a 1966 low. Pretty good. He has the 1987 crash correctly. He has the 2000 tech top correctly. He has the 2003 tech low correctly. So that's, you know, 1, 2, 3. I haven't gone over the other ones. I'm pretty sure.
So about 50%, 60% or higher.
Or higher for sure. Yeah, I would almost say over 90% if you probably go really accurately through it. Then he said there would be a high in 2010 and a low in 2011. That's correct too. You notice we don't have the 2009 low here. Maybe it is hidden in 2011. because I would always say give these cycles a year or two. But again, we get to 2018 for a major high and 2021 for a major low.
Got it.
Now, if we start combining that with Elliott wave, which I can go over for a little in a little bit, we can see that, you know, hey, this might say something. It could also be, like you said, Dale, that this is going to be a 10, 20% correction, maybe 30, and we're going to take off. That is absolutely possible. You know, I'm not going to put this work in stone. There's always a lot more going on. We went through some unprecedented time with quantitative easing, which could have extended some cycles.
Yeah, skewed a lot of things.
It skewed a lot of things, and for the better, I must say. I mean, nobody wants to go through a prolonged recession. That's not good for anybody. Trust me, I do not enjoy other people's misery, especially when the economy is down. It's horrible, right? It's horrible. I'd rather have a booming
I'm still
economy.
trying to figure out why they call it the Great Recession. It wasn't so great for me.
No, it wasn't great for anybody. I agree. I agree. So if we then go on, there's another, you know, if we use Fibonacci numbers, which are, you know, the series is 0, 1, 2, 3, 5, 8, etc. And here I'm going over the recent weekly digest I sent to my premium members, the ones that are paying for my services. There's an interesting pattern here. If we know of the year 1789, which was a very important low in the market, in the U.S. economy, and 1843 was a very important low in the economy as well, based on the contractive cycles, which is a 50-year cycle, which is close to 55, which is a Fibonacci number. Then we get 1789 plus 144, because 144 is a Fibonacci number. We get to 1933, which matches up again with what Mr. Banner found. Right. Now, of course, it was 1932, but, you know, 144 plus or minus 1 years. You know, it's kind of like, give it a break. You know,
it looks like the worst depression was the Civil War. It took over 20 years to come out of it. 26.
Yeah, yes, I agree. I agree. So then if we go to 1843, we add 89, which is also Fibonacci number, we get 1932. If we get 1932 plus 89, we get 2021. So there's a nice proportion here that point to 2021 as a major low, just based on Fibonacci numbers and important market and economic downturns and recessions. So if we keep on going, we just add these different Fibonacci numbers to the different lows and highs we've had. We just identified 32, we have 66, and we keep adding these numbers. We get 64 as a high, we come up at 66, 87 was a low. Well, here it is considered as a high, but it's true because it was such a flash crash. It was a high. Yeah. It was both. We get 2000, which is the tech top. We do 2000 plus 8. We get 2008, which was a market top in October 2007. Again, you know, please excuse the inaccuracy. Then we have 2008 was 5, which is a little bit odd duck. It's 13. There's really any high or low in 2013. So maybe this QA distorted a lot of things. Then we go 2013 plus 3, right? We keep going down the Fibonacci sequence line, which is a high both before Brexit and the US elections. We get 2016 plus 2. We get again 18, which was the recent high twice this year. And then we keep going till we eventually end up around 2020, 2021. Fibonacci based, we're kind of running out of options. And if we kind of keep going with these numbers, we constantly find 2021. Just adding, you know, it's just kind of having fun with numbers. It's not to say this is absolutely true, but, you know, when all things point to the same, you kind of start to get the weight of the evidence approach.
It's like confluence from different methods.
Yeah,
giving
exactly.
You the same outcome. Yeah.
Yes, exactly. So this is something that started in 1789. And you have an entire Fibonacci sequence pointing to the year 2021, which seems to say we could have a major market low back then. It seems to fit. Now, if it's going to happen exactly 2021, maybe it's going to be 2022. You know, nobody knows. But there's something pointing towards 2021. So what makes then from a Elliott wave point of view think of what is going on, I can pull up some charts. So the first chart I'm going to show here is a simple 5-wave move of the 2009 low. So it went all the way to 2011. We got our European austerity scare, I guess, right, in August of 2011. The market then chucked along really nice up to 2015. Again, Greece, I think, was in the news back then, supposedly causing this, a hefty correction. And then again, we have a nice 5 waves up. And every time a 5-wave move ends in Elliott wave theory, for those that are not too well versed in it, it will be met with a 3-wave correction. So if you get 5 waves up, you get 3 waves down, which we clearly had in 2015. We had an A, we had a B, and then a C. Corrections in Elliott wave always are lettered, whereas the advances, the 5 waves advances are numbered. So we have a nice clean 5 waves up, possibly from the 2016 low, with a quite classic, I would say, triangle formation here from the top in January of this year for a 4, and wave 4s are often triangles. Now the advance since has been pretty messy in the S&P 500. But if I go to the Russell, the advance has been tiptoey classic, picture perfect Fibonacci. So that
ended with a wave 4 triangle too, up to 5.
Correct. So we have here, we start here, we have the top in January of 2018. We get an ABC triangle here, and then we get a nice 1, 2, 3, 4, 5 waves up. As you can see, so red 1, red 2, red 3, red 4, and then 5. The third wave was 1.618 exactly, as you can see, times the first wave, measured from the low of the second wave, which is within the Elliott wave world, very known Fibonacci extension for a third wave. When that happens, most likely the fourth wave often, not always, but often drops back to the 1.0 extension of the first wave. As you can see, it did exactly that. Excuse the 10 points overshoot, but right? And then we get a nice, weird 5 waves up to the 2.0 extension. This is classic Fibonacci pattern, 5 waves extension. Now you can see the fifth wave is a little weird. It's not really classic 5 waves. It is more of a diagonal pattern. I only actually can count it into 3, which is a little weird, but if we say,
could it be an diagonal?
It could be a diagonal, and all a fifth wave has to do is simply make a higher high. I'm not too keen on trying to put mathematics to diagonals. People say it has to be this or that, but diagonals are, I find, really weird animals that often end up with a collapse, which we've just have seen back to the origin of the triangle pretty rapidly. So that tells me this is a triangle.
They're terminal patterns, right? Yeah. Okay.
Yes. Yeah.
I'm an amateur. I'm an amateur Elliotician. You know, I have an Elliott wave joke for you, Arnout.
Oh, okay.
Do you know why Elliott always waved? He was always waving. You know why?
No.
He was impulsive. And but his wife kept him in check because Mrs. Elliott was corrective.
Excuse me.
You could use it. All right.
I could certainly use it. So this also again shows we had a 5-wave terminal pattern of this year's low, which suggests this move of the 2018 lows in April has terminated, which we clearly are experiencing. Now, the question is, are we going to get a larger bounce and then a further drop? So that is always a little bit the question. There a lot of uncertainties remain in predicting what the market is going to do. But this is clearly playing into the idea that this, if we go back to the S&P 500, this fourth wave has finalized, even though the advance in the S&P itself is sloppy. Now, the S&P is a hybrid index. It's kind of a combination of the tech and the Dow Jones. And that I always find, therefore, to be the most difficult index to Elliott wave count. Whereas tech, like the Russell, which more small cap, is often very nice and easy to count. And the same with the NASDAQ 100. It counts really nice. Here we again have a fourth wave triangle pattern. This is actually called irregular running flat, where the fourth wave, since this is such a strong bull, was not able to actually move further lower than what we had in February, back in late March, early April. Just the buying power is so strong that the bulls just stepped in and went like, okay, this is just a fantastic level to buy, which is around 6,300 on the NDX. You clearly have a three-wave pattern up, ABC here, and then you kind of have an ABC down. And again, we see a nice standard pattern for a third wave, the fourth wave, again, exactly like the Russell 2000. And then here, again, we get that ending diagonal. Normally, the fifth wave would have ended here, just like it did for the Russell, right, at the 2.0. Well, so here I can go through. You can go on my website, go through my daily updates, which I've all archived.
You have nice content.
Here,
I've been there.
Oh, thank you. And then the market started to do something else. Here you would advise people, while the market has topped, I would go out. I wouldn't necessarily go short, but you can see here we get a nice ending diagonal pattern.
Was that a fifth wave failure ending diagonal up there on 5?
No,
and why the confusion of whether it's the end of 3 or 5, where the other averages you have it being 5 of 5?
Oh, okay. I'll go to the 3 versus 5 in a minute. So that the NDX actually squeezed out a marginally higher high in October. So did the Dow Jones.
By maybe 5 points or 10 at the
5
most.
points. Again, that's all the fifth wave need to do, right? We have this green wave. That's all it needs to do, and that was it. And you can see again, we collapsed right out of the start from this whole diagonal.
Went to wave 4 of lesser degree at the low, and now we're rebounding.
We're rebounding. I can see the futures are down a bit, so this is all as pretty much as expected. So what we here can see, so if we count it this way, it could be a 5 waves up. There is, however, we see, here in 2010, as Benner also said, there would be a high in 2010 and a low in 2011. Maybe this 2010 can be counted a little differently, like this. So we put the big 1 and the big 2 in 2010, and then we have a 1 degree lower first and second wave, and we move up. And now, instead of being at the terminal 5 wave of this bull, we are only at the third of fifth wave. Still does mean we will see a sizable correction that will probably take time and catch a lot of people off guard to buy the dippers. People have been buying the dip now for almost 10 years and start to become complacent. And given that we truly have, as the Russell and the NASDAQ shown, a complete 5-wave pattern of the 2016 lows, we should see a very sizable correction. Now here I've just kind of estimated the way forward. We can use Fibonacci retracement levels to find out how much of a retracement we should expect. And this 4th wave might go all the way actually back to around S&P 2000. I wouldn't be surprised if that's the case, but it's all depends on if this is correct, how bullish the market is, and where the real buyers, the big guys, start to step up again, or when they just really let the market drop lower and scare everybody out of their positions. That's a little bit unknown.
Okay. So say this is correct, and we get this wave 4 followed by a 5 to new highs. How do you project what the 5 could be price-wise after 4?
After 4th, the 5th, there's a few rules.
1 equals 5, or
that's the standard rule. 1 equals 5. Now, in this case, we have a very extended third wave. Normally, as I show with the Russell, the third wave is 1.618. Here we have a massive extension. This means the 5th wave is not as long and could only be as long as the first wave, which is from about 600 points. So let's say we're dropping to 2,400 or 2,500, then we would see a top at around 3,000, 3,100. That's it.
Okay,
So it's just going to be marginally higher above the 2940 peak we just saw. Maybe 60 points, maybe 160 points. Nothing really I would bet my portfolio long term on. As we know, and you mentioned, fifth waves can also fail just by a few points. So if
they
this
could
is the
also
case,
they can also morph into something parabolic too. How will you know you're wrong if we start trading over 3,100? Because I interview a lot of people that use Elliott, and I actually know of one who thinks that after this pullback we could see 4,200 in the S&P.
Oh, okay. Yeah, I'm definitely not in that camp. I'm sure we could get there.
Yeah.
For me, it doesn't line up with the bigger picture Fibonacci extensions. If we would use Fibonacci extensions, as I said, the market does need to move according to these patterns. As you can see, it really listens to them, because this is what we as humans, I think, would say is beautiful. Like, for example, the ideal hip waist ratio for a woman is 0.618, and right. So this is something that we think, and this is how our sentiment moves. There are nice Fibonacci extensions on the bigger time scale at around 3,050 to about 3,250. Where if we would go to a fifth wave, I would get really cautious when we start approaching those. I never believe in moonshots. I never advise my members to invest for moonshots. I actually already in September, if I go to my website, early September, I already told them we are approaching a larger market top. If I go to my weekly digest archive.
You have any view on some things that might run counter to it? Some people think it'll go together, like gold and the dollar. Any quick views on those?
I am of the believer that gold and let's see here, the dollar. Let's see if I can find it there. Move in opposite directions. If I take here the data since 1980, we clearly have most of the time when we see a dollar up, gold down pattern, and in red, the dollar goes down, the gold goes up. It's quite obvious there is this inverse pattern. There's sometimes no clear relationship for whatever economic reason there is. Not every relationship works 100% of the time. That's just the way it is.
Holy Grail.
Yeah, Holy Grail. What I am seeing in gold is the following, if that's of interest to you. And I'm going to use GLD because that's the one I personally trade. I actually just sold mine.
Interesting.
Why? Because I think we just did a fourth wave correction. Again, we have a nice. I actually thought, well, let's for once believe in my own work and sell a little bit here for a profit, and see if we can maybe buy it lower. This is kind of it doesn't have to be. We could have just a simple three-wave decline and be done. But I really would like to see it start moving over the 200-day simple moving average. That is, I think, always the key cutoff for a bull or a bear market.
Do you think that after we take out new lows at C, that could finish off the bear market that started, I think, in 2011 or 2012 when gold was 1,900?
Yes, I think that's going to be a very significant low. Very significant.
Do you have a number in mind?
Of how high it would go?
No, the lows. Under 1,000?
Oh, for gold, I guess I follow GLD. Sorry,
it trades at a discount to gold.
But around there, so slightly below the August low for gold.
Okay.
So around 1,000 plus, I guess that would be it. Don't sue me if that's not the case.
No. I'm not. I wouldn't want you to have to go back to Home Depot.
No, thank you.
Why don't you show? Yeah, you're doing okay, and Why don't you, at this time, show your website again, Arnaut, so that people know how to get a hold of you and follow
Yeah.
you and.
Yeah, so
Okay.
my website is called investingintelligent.com. This is where I post about once a week or every time I feel some urge for it, free updates to people. Anywhere from here, for example, how does the market respond to when the Fed raises the rates? Well, every time it did, it pretty much caused a market correction. And here we are again because it raised its rates in September. Darn it, Fed, stop doing it. You can reach me also on Twitter at Intel Invest.
Okay.
I have a Facebook page, so here is my address at Intel Invest.
What do you charge for your premium monthly membership?
Oh, right now, let's click on that one. I charge $49.99 per month.
Reasonable. Yeah.
This is, I think, very reasonable. It's definitely one of the lowest out there. The first week is for free. That's when people can kind of see if this is what they like. They can, of course, also go through my daily market archives and the weekly digest archives, which are published the weekly ones a month later and the daily ones 3 to 5 days later. Because I do want to give paying members, of course, firsthand information. And I follow pretty much everything. I do also follow the European markets, the Asian markets, gold, Bitcoins, everything, because everything adheres to the same principles.
You have an Elliott Wave view in Bitcoin? Do you think we bottomed?
I do. I post Bitcoin updates. Let's just go into my premium member updates so people get an idea of what I do. So here we have market updates that are updated about once every week. Then if I go to Bitcoin, my most recent, so I follow Bitcoin, the Bitcoin Investment Trust, as well as the NYXPT. This is from 10/8.
Triangle wedge, and you're looking for an upside breakout out of that formation.
Yes, I certainly do. I was certainly looking for lower prices, but if we can get a nice, serious breakout over this trend line, it would suggest that we may have patterned for a bigger C that just failed to break down critical support down to 2,000. It is always still possible, but I don't know what Bitcoin is trading at right now. I do it once a week, sorry, because actually it's not such a fast moving. It's nothing. It's like an EKG of a dead guy, and then it gets an electric shock, and it like Frankenstein on Halloween, and he pops up, and you get extreme volatility from a coma. So yeah, yes.
You like that?
Yeah, that is exactly what it is.
Let me wrap it with one thing, okay? And it's not market related. Your degree, your background in environmental sciences. Do you believe, like with all the hurricanes and weather and everything that we're having, are you a proponent of global warming?
I'm certain that global warming is occurring. I am uncertain about the degree of mankind's impact on the warming we are currently experiencing.
Okay, because I know some guys that are looking for exactly the opposite of potentially moving towards a mini ice age in 10, 20 years.
It is possible. I don't see it in the data. What I do see in the data, for example, is that the number of hurricanes, etc., has not increased over time. It's certainly, if there is any pattern, it's definitely not the pattern that has been predicted by models. But as an environmental scientist, models is not really science. It is, collecting data that you then put to the test by analyzing it to prove your theory.
Like Elliott Wave.
That's one of the reasons I like the market. The market is all about data. So I'm not a rocket scientist. I'm an environmental scientist. But the bottom line is I'm a scientist. I have the technical mindset of number crunching and pattern recognition, especially in environment. Environment is a lot of pattern recognition. Right? Do we see patterns in weather, in changes in climates, in ecosystems, etc.? Or that's what I'm kind of doing here. And LA Wave is all about patterns and recognizing patterns beforehand, so you can have a little bit of an edge.
You know what else? You know what else you are, Arno?
No.
You are now my trading warrior brother.
Oh, thank you so much, Dale.
You're in the club. You survived 30 minutes with Dale Pinkert. Not an easy thing to do. I told you we'd have some fun. Did I lie?
No, you did not. We really had a good time.
Yeah, and really, thank you so much for sharing some views that, there are a lot of people with Elliott have a lot of different views, real interesting with how you tied together the Benner cycle with fib numbers and it was really interesting 2021. So I hope that pips and dollars rain down on you during this time frame from now on into that key date of 2021 and afterwards. So thank you for your time today, Arnout.
Thank you so much. Thank you for having me, and I hope you all learned a little bit. I learned again and had a great time. Thank you.
Okay, everyone, that's Arnaud, and you follow him on Twitter at Intel_invest, and go check out his website. It's got some great articles. That's a wrap for me, everyone. And by the way, Arnaud, Tony Caldero's Twitter is at OEW Tony. So I'm gonna maybe put out a tweet to Tony. So good hunting, buddy, and see everyone tomorrow. Much. Remember, don't just count your pips, count your blessings. See everyone tomorrow. Adios.
Have a great day. Thank you very much.
Thank you, Arnaud.
Bye.
Bye-bye.